Hey everyone, this is Chris. Welcome to our webinar. This is November the 20th, and we're about a week away from Thanksgiving. Hope this finds everyone well. There's some unique things going on in the markets that we haven't seen in almost 20 months, and I just wanted to take some time out and share some of the current conditions, look at some of the opportunities. And so thank you for joining us today, and I hope you have a good time, have a little bit of fun. And do some other things along here besides fun. But I want to just share that I'm really humbled that people from 167 different countries are looking at our research. And after I'd talked with Sir John Templeton about getting something like this going, I'm just really humbled that each of you are taking some of your time of your day and often each day to look at our research and thoughts. And it's just really a blessing to have you following us. And just from my heart, thank you very much. So I want to just share a few of the things that I've been, where we've been featured on, and I'm very humbled again to all these different publications and stuff. And I'm honored that Mark Yusko, that is a brilliant man, is making really a lot of headways in the Bitcoin area. If you know Mark, you know what a great guy that he is. But he made the comment, the best thing about Kindle charting is the surgical precision of Chris and his team, putting out timely and meaningful content rather than carpet bombs of lines and charts. And Mark, thank you for your viewership and such kind words. It's very humbling. So before we get started, just a couple of housekeeping things, about today. The webinar is being recorded, and our intent is to email you the entire webinar within the next 24 hours. PowerPoint slides will be available upon request, and our email is at the bottom of the slide. And many of you sent in some questions, and I'm honored by those. I'm going to attempt to answer. I've crafted the webinar around those questions, some of them. And if I don't get to them, I want to have I'll individually follow up with you, via email. So pay close attention throughout the webinar, because today, at different parts of the webinar, we're going to have 4 giveaways at 4 different points of the webinar, and they're going to be a question and answer. And the first one to get the question and answer correctly is going to win the prize. And the biggest prize will be at the very end of the presentation, our largest giveaway. So how do you participate in the giveaway? It's really simple. If you'll notice, there's in the GoToMeeting, there's a little green bar off to the right side of your screen. And so to activate that, see the red arrow, or the green box where we're highlighting that, and how to participate in the giveaways is to click on the chat box. So you see the red arrow, click on that to the left of it, and then what's going to happen is it's going to open up the chat box, and then you can type your answer in the chat box with your with the answer to our question. And then what's going to happen is the first correct answer, we will look at this, will then get that given prize at that point in time. So again, I have some other thank yous that I wanted to give, because whether it's on our blog or Twitter or StockTwits, thank you for the following. We've got about 80,000 followers on StockTwits and over 30,000 on Twitter, and that's really very humbling. And a couple of years ago, the viewers on StockTwits voted us Chart Artist of the Year, and I'm still very humbled by that situation. So just to talk about today's format a little bit, we're going to look at where the next best investment idea is today under the current conditions. Again, pay close attention, because there's going to be 4 giveaways. But then a reminder, there's going to be an offer that's exclusive to fast-acting people. There's going to be a bonus to the first 30 people, and you'll find out what that is at the end of the day. So before we go on, I'm going to just I'm going to shut off the camera. You probably had enough of seeing, me for today, but I wanted just to be able to say hello to you and stuff. And so now we're going to get to move on. And so this slide is going to have to do with your chance of participation or winning some in the slide or in the giveaways later on. So these are some of the passions that I have in my life. So you might just kind of want to take a mental note of this slide, and then we'll be coming back to it throughout the webinar. But a reminder that I'm not a bull or a bear. Opportunities take place in all kind of markets, and in 3 more months, I'll be celebrating my 40th anniversary in this business. And the biggest train wrecks that I've seen in that 40 years have been people that have been either a perma bull or a perma bear, and they've missed a lot of opportunities. And so, bull markets happen all the time. Bull markets can take place in falling markets. It just depends on how you play it. So again, I don't have a preconceived, notion of what's going to happen. I'm not smart enough to figure, that out. This is exactly where we're going to be. So many contests. Where's the market going to be a year from now? I've never participated in one of those. I think they're, a little bit tough and silly to do. My mentor, Sir John Templeton, and before he passed away, one of my promises was at a point in time in the 1996, after a meeting with Sir John, he said, outside of the Bible, Chris, he's known, for several things. The Templeton family of funds, unbelievable performance in his portfolios. He gives away more money every year, despite he is deceased. He still continues through his charities to give away more money every year than the Nobel Peace Prize in the prize for the greatest achievement in religious education each year. But what caught my attention, he said, Chris, outside the Bible, there was one book that he had learned most from, and it was this book, The Extraordinary Popular Delusions and the Madness of Crowds. So at the time that he mentioned this book wasn't readily available, but it is today off Amazon. If you haven't read it, it's a game changer. You will look at things differently. So again, I can't emphasize enough. Go out and give this book a purchase and a read. It can be a little tough, but you will look at news headlines and manias, what people say, your neighbors, your family, people at the workplaces, around the water coolers. You'll just hear things differently after reading the book. And one of the last things about Sir John, he's famous for these 4 parts of a bull market. Bull markets are born on pessimism, and then after the pessimism changes, they still grow on skepticism, they mature on optimism, and they die on euphoria. So I want you to kind of keep these 4 stages in mind. I challenge you to think about any asset class that's taking place, whether it's the metals, it's bonds, it's stocks, it's currencies, different commodities. Where do you think they might lie on this 4-part sequence? And when you get to thinking about these things and try to find measures of actually analytical tools that can help you measure these, this sequence and reading that book will help out a lot. So we always hear the thing of what 2 things do you have in common, which are death and taxes, but my question would be is what 3 things does everyone have in common watching this webinar today? And it's death and taxes. And the third one is our financial success in the markets is based upon our entry and exit points. And so the Popular Delusions book can help you keep away from some of the noise that I think is a distraction and a hindrance to people's performances. And your performance most likely is not based upon these news headlines, how the presidential impeachment hearings are going. Is the PE ratio high or low at this time? How about the margin debt? How's the yield curve acting? Is the Fed doing the right things with interest rates? How many pensions remain unfunded? How high is our total federal debt? Are we going to wrap up a deal with China, and are the tariffs impacting things? And are we headed into a recession? Those are the issues that I think draw people away from success. And today we want to focus on the charts of the answer and getting to know the charts so you can find quality entry and exit points. That's where you're going to increase your success. And to me, it's about partnershiping. Like I said, this is my going to be my 40th year in the business. And I want to help teach you how to think, how to understand some of these things, chart analysis, and how to create these charts. We're here to help. And I believe, together, no different than when I had my financial planning practice, I help people get along the way, and we're doing the same thing today. So we want to start off with one of our most popular product happens to be a combination of different research reports. And one of them is about global trends. And the reason I want to start off with this is, in my humble opinion, of all the research that I can provide, this report discussing global trends, to me, is the most important. And the reason I say it's the most important, I've got 2 pictures up here of a fighter, and then somebody following. And you've got a choice. All of us have a choice to be a fighter or a follower of trends. And as I've noticed over the last 40 years, the people that had the biggest train wrecks, struggles, under par performance, frustrations, and anxiety, they were fighters. And what's ironic is some of the people that I've met that are the fighters, they're brilliant people. They're some of the smartest people that I've met, but they try to fight the trend versus relaxing and just letting the chart performance and the trend be your friend. So if I can encourage anything, find a system, find research that can help you be a follower and just go along for the ride. And so this was provided from JP Morgan. This is a current piece out of their Guide to Markets report of October 31st. So it's a couple of weeks off the print. But I found this is interesting, and this is their look back on different asset class performance over the last 20 calendar years. And so you could see REITs, gold, oil, S&P, 60-40 blend, 40-60 blend, bonds, EFA, homes, inflation, homes being real estate, inflation, and the average investor. So with the S&P being very, very popular, you can see that the average rate of return over the last 20 years, being 1998 to 2018 for the S&P, is 5.6%. So that's the bogey performance-wise. But the thing that sticks out to me the most is the lowest number on this scale, and that's the average investor at 1.9. And so then another number that sticks out to me is the one right next to it, which is inflation. So the average investor's performance over the last 20 years has underperformed inflation itself. And so, I used to talk about, when I first got in this business, certificates, CDs at a bank were yielding 15%. And so I got to thinking, what is a CD? But at that time, the CD was yielding 15%, but in the early 80s, inflation was like 18%. And the CD stood for Certificate of Depreciation. And so the average investor's performance is really a certificate of depreciation to inflation, that it's actually lost money going through life, and so what I want to help is you can't stand or you can't afford to spend the next 20 years being average and underperforming inflation. And so I think one of the main reasons you see this image of this guy on a horse coming in is, to me, it's about trend fighters, folks, that they're looking for other answers, but they're not riding the appropriate trend to their advantage. And I think that's why, to me, this global trends report is the most important research, because it's pretty hard to do well, folks, if you're not on board the trend correctly and that you understand it. So one of our benefits, is that charts are the answer, and the trend, knowing that trend is just so key. And so this was from JP Morgan's most recent report as well. It's kind of busy here, but just kind of boil it down. There's kind of an olive green colored line. That's the S&P 500. And then the vertical bars are the flows into mutual funds and ETFs and indices on a quarterly basis in billions over the last 20 years. But the thing I want to just kind of go back to fighter versus follower, let's just look in the last couple of years. So you'll notice that the 2015 high in the stock market, what were people doing with their money? They were piling it into the market, and they were piling it in, it happens to be in hindsight, right at the high. But the thing that I noticed the most right next to it is the market takes a dip in 15-16 through that time frame, and it doesn't show that it's fairly decent size in that window, but look what happened to the flows. And so what if you, and I didn't do it, folks, I should have, but what if you were to draw a rising support line off the 09 lows and 011 lows that in 15-16, it didn't even break that support line. So you see that people fought the trend. They essentially bought at the high, sold at the low. And again, that's where the average investor comes in with such poor numbers. Then let's just look back calendar year 2018, the last part, the early part of last year going into Christmas of this past year, 2018. But you'll notice, so the S&P was setting an all-time high. Look where inflows were. So again, they were buying the high, but again, we saw the almost a 20% decline into Christmas. But again, folks, it didn't break any long-term support lines. And what did people do? They bailed. So again, they bought at the high, sold at the low, and because they most likely were not aware that the 10-year trend at that time, the 9-year trend, had not broken They made a poor decision. And so what's ironic is from a calendar year, 2019 performance looks pretty good. But if you think about it, folks, if a lot of people bailed in late 2018 and then look at the flows this year, they've bailed even more. Again, the average investor has missed the trend. They've missed the ride. We want to help you make sure that you can say, I'm not that average person. So here's a 4-pack of the major indices. And the upper left's the Dow, the upper left's the S&P, the upper right's the Dow, the lower left is the Qs, the NASDAQ 100, and the lower right is the transportation index. But I want you to notice where these arrows are. Now, this is Christmas of last year where I've highlighted these arrows. But watch what happens when you start thinking of riding the trend as we start drawing in rising support lines. All of the markets came down and did what? They had tested these rising support lines in 15, 16. Each index did in 15, 16 and didn't break them. They came down and touched them on Christmas. That's when people bailed. But guess what? If you didn't have a solid mechanism to help stay on board, the charts were the answer to show the trend did not break despite the 20% decline. And we're not going to get into that was a bear market or it wasn't a bear market. I'm not into those type of definitions. But I want you to look at the upper left. Look what happened to the S&P after it hit that support line. Boom, new highs. Let's look at the upper right. Let's look at the Dow. Boom, new all-time highs. The lower left, NASDAQ, boom, all-time new highs. And the transportation, which is a lagging index, it's still bounced off to that. But of the 4, that's the lagger. But 3 of these 4, as we all know, are at all-time highs as we speak. So one of the things that I think is, to me, very fascinating, and it doesn't matter that I've been in the business 40 years or you've been in the business 4 minutes, you'd have just as equal opportunity to look back in hindsight. But to me, charts are, what are they representation of? A couple of things. All known knowledge to every man and woman on the planet and emotions. Charts represent emotional extremes. So in my opinion, when you look back, the 2 most important price points that you want to start applying Fibonacci to are emotional extremes, looking for repetitive patterns in a noisy world. Try to get it to settle down a little bit for you. So to me, the high in 07, pre-financial crisis, and the financial crisis low in 2009 are 2 of the most important extremes in emotions over the last, 15 years. And so in this chart, we applied the Fibonacci to the 07 high and the 09 low, and you'll notice the 161 extension of that whole move came into play here in this blue shaded box, or the dotted line coming across here, around S&P 2150. But the thing I want to highlight is what happened as it approached that key Fibonacci extension level off those emotional highs. That the S&P started trading sideways for a couple of years. And oftentimes, it's not bulletproof, folks, but oftentimes in an upward trend, when you see a market going sideways for an extended period of time, is it building a top or building a base to push higher off of? Well, this was a prime example that it was building a base to push higher off of. And you'll notice that the S&P broke above. And then what is an ideal technical formation would be a breakout of a 2-year resistance level and then come back and test it as brand new support. And you'll see in November then of 2016, it came back and tested almost a 2-year topping process as new support, and it blasted off to the tune of 50% in 12 months. So then if you'll look that over almost since January of 2018, as the S&P has approached the 261 extension level, again based upon the 07 highs and the 09 lows, some choppy action has started taking place. So we've been 21, 22 months since this process has started. But to me, it's even more evident when you look at the other indices, that the Dow, look how it looks more like how the S&P looked in 14 through 16. And so did the NASDAQ. Now we applied Fibonacci to the dot-com highs and the 03 lows after the 90% decline. And so this is what I shared earlier, that doesn't matter how long you've been in the business. To me, this was the most unique cluster of Fibonacci extension levels that I could find in hindsight going back 100 years. And it didn't matter how long you'd been in this business. This was one unique setup. But you'll notice in these blue shaded boxes, each have traded sideways for a good part of the last 12 to 20 months, trading sideways just below the extension levels. But what do you see now by 3 of the 4? If you look at the S&P, it's trying to break above that. If you look at the Dow, it's trying to break above it. NASDAQ breaking above it. And the only one that so far hasn't is the transportation stocks. Now, you know, somebody said history doesn't repeat itself, but it often rhymes. If you think about the previous slide, if we just go back to it, you know, real quickly, what happened in 2016 is it broke above it, similar to what we're seeing now, but it came back and tested it as support. So to me, that's an ideal circumstance if we would see the same thing again. Now, can an asset break out and never look back? Happened many times before, and it could sure happen again. But that would be, to me, an ideal test to see if the breakout is legit. So another breakout that I think is really important or catching my attention is the semiconductor index going clear back to 2000. It peaked in 2000, you could see around 100 and fell all the way down to about $15 a share. This is SMH, 85% decline since the '09 lows. It's rallied and it came back, and you'll see that it's spent a couple of years on both sides of the 2000 highs, and now we're seeing it pushing higher. This is, to me, a leading, the guts of the computer that you're most likely on a computer or a cell phone right now. It's really important how the semiconductor index is doing. And in a way, when you look at the semiconductor performance compared to the S&P, which is the chart on the right, that's the SMH SPX ratio. While the S&P was trading sideways for a couple of years, so was this ratio. And then once it broke out, so did not only did the ratio break out, the S&P broke out. Now, as you can see, SMH was much stronger than the S&P. So even though the S&P rallied 50% in 12 months, semiconductors rallied tons more, you know, than that. So again, what are we seeing currently? This ratio is traded sideways for 2 years, and now we're seeing an upside breakout of a 2-year trading range. So some more evidence for the trending that if you're fighting this, you're missing out. This is where right now the opportunities, the trends are solidly higher. And speaking of a big trend, this is the NASDAQ going back 20 years. And in building a chart, what you want to try to do is start with the lows, in my opinion, to try to determine highs. So let's go and take the 2002 low and the '08 and '09 rising bottoms, and let's create a long-term support line. Then on your own, sometime later on, then take this line and do a copy paste and tie it to the 1990 high and see where that could take us in the future. So I found this one interesting because I did the same thing for the NASDAQ, going back to the '09 lows, took the bottom of the chart, took the top of it, and lo and behold, look at this really uniform rising channel. It's breaking above the 161. And so the next key level downstream for the NASDAQ 100 comes into play for the Qs around 285. So this is a big test. Again, what would be the ideal circumstance? That the NASDAQ, under current conditions, would fade back down, double test the 161. If I had a perfect bucket list technical wish for technology, is for this trend to stay up, it retest the 9-year, 10-year rising support line, and the 161 extension level here, and then push higher. So let's watch in time. Many months from now, we're going to continue to have these client briefing meetings like this. So we'll definitely revisit this chart going forward. Another really important chart to be from a trending perspective is the NYSE. It's been a lagger. It's actually lagged the S&P since '09. So it's lagged it for a long time. But finally, the NYSE is testing last year's highs. So there's two circumstances here. The trend is up. It didn't break long-term rising support that I didn't draw in here, but it's testing last year's high. So to me, as the guy on the left says, do we pay attention to price, and it's testing last year's high, or do we pay attention to momentum? So all that pays is price. Charts are the answer, but this is a big test, everyone, when we're seeing this momentum falling and some of the sentiment extremes we'll discuss later on in the webinar, you can see this is a key price point. If the NYSE, which is roughly, what everyone, low 2000s in the number of issues in the index, if it breaks out here, a very positive message from this very large index. So one of our proprietary tools, something that I've had that we share every week with Global Trend members, is what we call the Shoebox Indicator Report. And the Shoebox Indicator Report is an in-house piece, but I want to share with you a couple of things. Why did I name it that? And what's kind of its basic makeup? So I named it, rightfully or wrongfully, the Shoebox Indicator, based upon the question of, should we hide our money under the mattress, or should we be in a trend, taking advantage of growth opportunities, not fighting the trend, riding the trend, not being a fighter? And so the Shoebox Indicator is related to bonds and in the junk bond complex. It's not a junk bond indicator, but it's a cousin to it. And so it mimics, it has some personality characteristics of bonds, of junk, and also of stocks. So the thing that sticks out to me is going back to January of last year was, you'll notice that there was actually a negative divergence taking place, that the Shoebox Indicator on the top was making level highs while the S&P at the bottom was moving upward. So in a way, this is a mild divergence taking place. And then you'll notice that the Shoebox Indicator broke rising support, multi-month support, and yet the market continued to go up for 4 or 5 weeks. And so this is what this type of indicator or tool has helped to suggest that are some trend changes, some underpinning weakness that's going on that a lot of people might not see. But then on the flip side, you'll notice that the Shoebox Indicator actually did a bullish reversal pattern and bottomed on a weekly closing basis a week before the broad market did. So it helps mostly at tops, but it has confirmations at the bottoms. So the thing that intrigues me is not only this support break here and this bottoming process here, it's what took place last week. And you'll see over the last almost year, this is one of the largest bearish reversal patterns that this Shoebox Indicator has made, and it's actually made 2 of them in back-to-back weeks. And you'll notice that the last time it started throwing off those type of patterns was right here close to this past summer's highs before the market took a dip. So to me, we're paying really close attention to the Shoebox Indicator, and then we'll pay even all the more attention if it would happen to break this rising support line. So from the health of the market, this is one of the things in the Global Trends report each week is, how's the health of the advanced decline line? And so to me, this is one that I really find it hard to believe that people have been fighting the trends in looking at an indicator like this. And so this is the NYSE advanced decline line on a weekly basis. You can see it's very cleanly, it's remained the only suspect to the rising trend took place in 2015-16, where there was a throw under of the rising trend and then a quick reversal. So right now the trend is up. The AD line is sending a positive message here. And this is a reminder, folks, to me, when you see people, friends, relatives, money managers, people in social media, when they talk about the market being broke, humbly, folks, in my opinion, there's no such thing as the market being broke. The only thing that is broke is either their outlook and their positions, or both. So when you see people talking about this market is broke, to me, those are the ones that are the fighters. They're struggling and they're losing money most likely. Because ask yourself this: when's the last time you heard somebody that was making money saying the market's broke? It's just not a common factor. So again, as we wrap up this piece of why I believe being a trend follower versus a fighter, we saw these numbers earlier. Average S&P return of 5.6%. Over 20 years, the average investor 1.9. In summarizing all of this, to me, I got a couple of images at the bottom. You see this yo-yo? What I think people get really caught up on, folks, is watching this constant back and forth yo-yoing in the market, and yet they forget to look at the escalator or the upward trend that's taking place. And so it's easy to get caught up on the yo-yo, but to me, that's why so many people are struggling, is they're using the left image, getting caught up on shorter term pieces. They're not allowing charts to be their answer. Let the trend be their friend. Ride that escalator when it's it. Now that escalator someday will be a down escalator. There's no doubt about it. But until the chart gives you that message, ride the trend, let it be your friend. Okay, so for a little bit of fun, this is the first quiz of the day, and it'll be the first one to answer the question correctly will get a 90-day subscription to one of our weekly reports. And again, those weekly reports are what we just went over, the global trends, which I still feel is our most important report to try to get the trend right, or the metals report, or the sectors of commodities, your choice. So again, remember the bar on the right, you hit the orange arrow and let it come out, expand the chat box to give the answer. So it's the first one. And folks, we're not going to try to tell who wins the quiz during this webinar. We'll get back, with you later. Thank you for participating. I just want to have some fun, with this. But here comes the question. And the question is, the average number of miles ridden by yours truly, Chris, per year on his Peloton bike. That's the exercise bike that you most likely see advertised on TV. And as a lot of you know, their stock went public here recently. So do you think the average number of miles that I ride in a year on the Peloton is a couple of thousand, 3,000, 4,000, or 5,000? And I'll give you a few seconds to think that over and put your responses in the chat box. Okay, we probably had time, and go ahead and give you the answer is about 4,000 miles. So if part of the reason we're going to recap this, but if you have a Peloton and you'd like to tie into to what my username is, I'd love to communicate with you on the Peloton. It's a great vehicle. So shoot me an email, and I'll return you with what my sign-on name is on the Peloton, and we can get some things started, maybe have some fun exercising together, regardless of where you are around the world. So now let's move to the metals section, or the metals report. In the metals report that we send out weekly, we cover all aspects of gold, silver, the miners. I didn't put it on here, steel, and also copper. So I want to go backwards, and because we just talked about understanding the trend and how important that is. So this is a copy of a post that I made on September the 1st of 2011, because I believe so much in trying to get the trend right. This post was about a long-term trend. In my humble opinion, I thought it was ending, and it was going to cause probably a lot of frustration for the metals community. Now, it wasn't greeted very well at the time, but my idea was the Swiss franc, and again, it was charts are the answer, folks. And we'll go into the chart in a minute, but this was the headline that Swiss franc is suggesting that gold will be flat to down for years to come. Will it be different this time? And so here's a closer look at the chart. The top chart is the Swiss franc. The bottom chart is gold, and the upper left, the guy yelling in the phone, that was the average response that I got from people based upon that were riding the trend, and they were essentially saying, no way that this long-term 10-year, remember, at that time, folks, gold had went up 10 calendar years in a row. But what I had noticed and again, to me, one of the biggest mistakes that people make is they get very micro in the trends, and they forget to look back on a 5-year chart, a 10, a 15, a 20, and a 30. Later on, we'll talk about, do charts have memories? I do believe, and we'll show many different reasons why long-term support and resistance line that can date back not only weeks, not only months, not only years, but you can get into decades, can impact decisions in the overall marketplace. So at this time, the Swiss franc was touching in 2011 a 30-year resistance line. And you can see this monstrous bearish reversal was taking place. And so anytime that the Swiss franc had been up to this rising resistance line, gold had struggled for years to come. So we had it touching this resistance line for the first time in 15 years, creating a large bearish reversal. Gold was up against a 10-year resistance line itself, and the percentage of people that were bullish gold was 85 or 90% at the time. And so it paid to know that the trend was changing at the time. You know, so if you'd had, you know, congratulations, high fives if you'd had the truck backed up at the time. But what this was suggesting, the charts were suggesting to empower you that the game was moving from trending to trading. And so here's an updated look now on what I think is important, the important messages of the Swiss franc and gold. So this looks back, clear back into the 90s. You can see that the Swiss franc made lower highs for about 7 years. So did gold. They were confined in bear markets, and they just couldn't get out of their own road. But yet, what happened? In the early 2000s, both of them at the exact same time broke above 7-year resistance lines. And boom, you went from trading to trending. Not only backing the truck up, you didn't have to know right off the bat to back the truck up, but it was a time then that the trend was your friend, to not fight it anymore after 7 years of that the trend was not your friend. And so then it rallied for 10 years. But then you'll notice this is the spike in 2011 when we said gold should be flat to down for years to come. So to me, one of the really powerful takeaways is to folks to use the Swiss franc as an ancillary confirmation tool that until the franc can break its 7-year falling resistance line or 8-year going back to 2011, and the same with gold, right now it's still saying this is not an upward long-term trend. This is a trading opportunity, but where does it change? You know, what would make it different that if it does, if both break out above these long-term resistance lines at each one, similar to what they did in 2002, most likely the personality of the metals complex is going to switch from trading to trending. So again, some really big tests going on. It's got to play a game of prove it. Price is the only thing that pays. Charts are going to be the answer. We want to provide you those answers on a weekly basis. So we're sharing this chart with all Metals Report subscribers each week. Another key indicator of trending or trading to me, or trending being buy and hold, where you can just sit back and sip a Bahama Mama and just let the metals or any asset be your friend, is the silver gold ratio. And this is right here at this spike in 2011. That's when we said that we thought metals would be flat to down for years to come. And you can see that when silver is underperforming gold, or in other words, the ratio is going down, most likely the metals complex is struggling. And so this ratio has declined now from 2011 clear down here to 2019, that it's testing 25-year lows. So this is a monthly chart, everyone. So just within the last 6 months, the 1992, 91 lows were tested. So far it's held. We've seen some upward action. You see a couple of months ago, a large bearish reversal pattern at 2. So one of the key ancillaries is start adding this into the mix, that if you would see the franc breakout of 7-year resistance, if you would see the gold breakout of 7-year resistance, and you'd see the silver gold ratio breakout, that would start giving you evidence and confirmation to move from trading to trending. So another piece that to me has some exciting possibilities is Freeport-McMoRan, under the copper umbrella. Freeport is in a downtrend, and you can see from this red shaded channel going back from early 2018, and it's declined from from $21 down to the low is just under $9. Just call it $9. So this, obviously a 50% decline. We see that it has a potential double bottom at that 873 level, and now it's rallied up to test dual breakout resistance. So right now, resistance is resistance until broken. This is where Freeport and has let the bulls down over and over, what, 1, 2, 3 different times over the last couple of years. Now, maybe the fourth time is your friend, but we'll see. But the lower highs of this past year and the falling channel come into play at 2. So if Freeport would happen to break above this dual resistance at 2, to me, you'd want to be long this asset. The next key horizontal resistance level comes in just under the $15 level, which is about 30% above current prices. So to me, in the metals complex, this is a spring that's wound up tightly. There is an 800-pound gorilla sitting on top of it, but if Freeport can knock that gorilla off, this looks like a heck of an opportunity in today's mining complex. And speaking of miners, CDE, this pattern really catches my eye. Looking back, that this line that started at 2014 was at one point support. It was resistance. A real breakout took place here. Support again in 17, so it's now kissing the underside of this 5-year support resistance line. It's also kissing the underneath side of this falling resistance and this rising resistance, all at this around the 683 level. And so if CDE can break above here, it could rally a good 15-20% quickly. So this is something that we're keeping a close eye on again. And again, charts are the answer. Let price confirm it. This is in a downtrend, CDE is, but if you have a breakout, there looks like a heck of an opportunity. So, the commodities sector, kind of wrapping up this whole area, has been frustrating to commodity bulls, I would suspect, going clear back to almost 2008, but primarily 2011. But this is a chart that I saw from at Sober Look, and they were looking at the flows in and out of commodities. And you'll notice that for a good while, a good part of 2016 to 18, there was fund flows in, and then you just saw a lot of exodus. People threw in the towel. But now some of the outflows are drying up, and they're about net neutral now. And so what has my attention is, should you make an investment based upon the fund flows? And to me, I wouldn't do that. To me, charts are the answer. And so to me, this is a really interesting chart below. This is the Thomson Reuters Equal Weighted Commodity Index. It's testing the top of a 7-8 year falling channel here at this price point number 1. And this is a monthly chart, and you can see that it's nothing is proven, but it's this has been a letdown point that has led investors down in 2014, let them down again in early 2018, came close to it last year, and now it's testing it again. But if it can break out here, this would be a significant trend break. So right now, the trend that we've tried to emphasize, don't fight it. Right now, you want to fight the trend, because if you're long, because the trend is still down. But this is going to be a great breakout point to take advantage of. And so this is something we're keeping our members of constantly every week, because this is a really important chart. And there's just so many messages that could come out of here. If commodities could turn up, maybe we could move from a disinflationary environment to more of growth. All right, so that wraps up our section, on the metals, silver, copper, and the miners section. And again, that's a weekly research report that stands all by itself. So now we're going to enter into the second giveaway. And again, the winner will get a 90-day free subscription. This is for non-members only. This will be a 90-day subscription to one of the weekly reports, Global Trends, Metals, or Sectors and Commodity Extremes. So have your box out, have your chat room ready. And the question is how many grandchildren does Chris have under the age of 7? So if you have a photographic memory, or if you did some counting on the very first slide, that was an answer. That was all of us a couple of weeks ago at Halloween. And if you saw me on the video at the beginning and you saw the Halloween picture, that was a fake mustache. So I was pretending to be an old gray-haired Ghostbusters left over from the 70s. So we had a good time, and that was a picture of we're really blessed with some wonderful grandkids, and I hope all of you that have children and grandchildren that you enjoy them just immensely. They're obviously one of the best investments that's ever been made by our Heavenly Father. So I think we've probably given you enough time, and just to let you know, the answer is we got 10 little ones under the age of 7. And so our place gets a little busy when we have all the beautiful grandkids hanging around here. So we're going to move on to what I think are some really, this is part of the reason I kind of saved what I think is the best for last, that some things are taking place today in the marketplace that we haven't seen often in the last couple of years. And in the last times they took place, they presented really quality opportunities and inflection points. And so we're going to get into covering aspects of our sectors, commodities, and sentiment extremes report. And so I want to start off with something that, I don't know if any of you drink coffee on, that's listening today, maybe having some coffee right now, trying to help stay awake through Chris's presentation. But again, to me, this is why it's important to look at long-term charts. And so this is a chart over the last 40 years of coffee futures. And the thing that sticks out to me is these protracted, very clean, parallel falling channels, lower highs, lower lows that lasted for years. The shortest one, was what, like 3 years in the early, from like 94 to 97 roughly. And then the longest one, was from what, 96 clear to 02. But the thing that stuck out to me was after these extended bear market parallel falling channels were taken out to the upside, some really quality rallies took place. And when you put the math together, there was a 300% rally followed by a 150% rally, a 400% rally followed by a 90% rally. Kind of put it in the Vitamix and spin it around, you come up with over a 200% average gain coming out of those falling channels. And so part of my obligation and excitement is to share from all my years of experience these type of patterns that are taking place. And so this is a look at coffee. That coffee was trading a few years ago at around, let's call it the 180 level, recently reached around 90. So there's a 50% haircut. But while this haircut's going on, you see a very uniform falling channel with a counter trend rally taking place up to price point 1. So this is something that we've been sharing with our customers on a weekly basis for months and months, because this is something, thinking back to the Boy Scouts and trending, if you were bullish, I hope you haven't been riding this trend. This has been a trader's market. The trend is definitely down, but there's a chance to now you could stop being a fighter and become a follower if we have a breakout for a period of time. So here's an updated chart on coffee through today, that you can see that from 2017 we got a 2-year decline inside falling channel 1, but coffee now is knocking on the top of that falling channel and also the red falling resistance line at 2. And so it's attempting to break this bear market that's taken place, this 50% haircut. So as of earlier today, coffee futures were priced at about 108. And if coffee could break above that 108 and then clear the lower high of a couple of months ago around 115, probably got to rally pretty quickly up to the 125 level. So from a percentage basis, that's a nice little gain. And then the next resistance point, above the 125 takes you clear up into the 140s. And so again, a reminder, when coffee broke above these long-term falling channels, the average gain was 200%. And if we just go backwards one slide, let's just do that for a second. The smallest gain out of these was 90. So if we would take a 90% gain on a, call it 100, that would take it to about 200, which would be back to the 2016 highs. So you see this piece coming in at the bottom. This is the seasonality chart for coffee. And so as you see that coffee is testing a breakout level, you'll notice that two of the strongest months for the entire year for coffee have taken place in December and February. And January was also a gaining month, just not quite as high. So if you would package a 90-day window for coffee, the next 90 days, which would be December, January, and February, are the best 90 days of the whole year for coffee as it's testing this breakout level. So it could be a really good opportunity from seasonality and a breakout of a falling channel after coffee's declined 50%. So here's another asset that, no pun intended, has really stunk things up, and that's natty gas. And this will be something that I sure hope that you weren't bullish on the product itself, because you'll notice that the 2008 high natty gas futures were trading just under 15 bucks. Today's current price is around $3. That's a heck of a haircut. But the thing I've tried to emphasize several times is the long-term charts and why they're important. And so this chart, there's no doubt natty gas is in falling channel 1. This is a bear market, no doubt, just continues to make lower highs and lower lows. But there's something that's possible, far from proven, everyone, but something that, you always have to play the game of what if. You'll notice that the momentum up above, there's been 3 different times that it has, or 2 different times, excuse me, over the last 8 years that it reached very oversold levels, and that would be 2012, and you can see that it rallied from 2 to about 7, not a bad rally, and again in 2016 from about 1.5 to about 4. So again, these were over 100% rallies from oversold levels. And what has my attention is, and the question to ask is, could natty gas be creating one of the longest term basing inverse head and shoulders of any asset that you could go find looking back in hindsight? And so to me, it's possible. It's going to take a lot to prove if this pattern is true. It would take a heck of a rally just to make it up to the neckline, folks. But the thing that intrigues me, right now, roughly at current levels, is that there was this line was support numerous times, 1, 2, 3, 4, 5, 6, 7 times, resistance twice, a breakout above it 2 weeks ago, a bearish reversal pattern, and now it's coming back to test this. What was a support line for 7 times was a resistance for a couple, had a breakout, and now it's testing it as support again, as you're seeing momentum starting to turn up. So if natty gas can clear this resistance level, even if it did nothing more, folks, than rally to the top of this bearish falling channel, that would take it to about 450. And that's a heck of a percentage gain off of today's 250 levels. So again, these are some really out of favor, probably not talked about assets, being coffee and natty gas, that are forming some really interesting long-term patterns that I want to empower you and make you aware of. And again, charts are the answer to just follow. If you have breakouts, you want to be on board. So I'm going to talk about one of the main reasons that I wanted from a timely perspective to talk about now is conditions. A lot of you know that if you've watched any prior webinars, I turned 62 this past year, spent the majority of my life in Kansas. And in Kansas, if you look at a weather map, we're known as Tornado Alley. And so the one thing that you become really aware of when it becomes weather-wise is what are the conditions for possible storms. And so this picture scares me. You can see this is a series of how many? 1, 2, 3, 4, 5, 6, 7. Is it photoshopped? I don't know. One's too many. If that tornado is bearing down on your house, that's all that it takes to really change your life. Obviously, it can take your life, but it can also materially change your life. But the key that I'm showing this slide is, and why, is understanding market conditions, no different than weather conditions. Just because there are conditions that are right for a tornado doesn't mean they'll occur. Just because their sentiment extremes take place doesn't mean that the market has to shift on a dime because of that. But here's some conditions that I wanted to share with you. And so this first image up here in the upper left is the market long in the tooth. And so this chart looks at, from the Leathhold Group, different bull market rallies since the post-war era in the 40s. And so it doesn't mean that the market has to stop, but the rally off the '09 lows is now the largest post-war rally that we've had. And it's up 468% according to the Leathhold Group as of November the 4th, and it's continued to go up since then. So right now, that doesn't mean that the market topping is topping. We're going to reverse or a bear market or any of that, but from a perspective piece, it's an outlier because it's now all by itself. This is the largest post-war bull market rally in American history. If you're not aware, a great website is Advisor Perspectives. Under Advisor Perspective umbrella is a website for my friend that Doug Short had created years ago called dshort.com. But this is one that I've tried to pay attention to for a long time, but let's just look at this. This is two charts in one. The blue line is the S&P 500, and the red line is margin debt inverted. So I wanted to just kind of show how much of a unique spread that's taking place, and then what do you look for in margin debt. And so I've tried to share with friends and followers for years that margin debt being high is not a problem in and of itself, but when margin debt tends to contract, in other words, people start withdrawing and becoming more concerned about their risk propensity, that's when the market has struggled a little. So let's go back to the 2000 highs. You can see here was the S&P, there was the inverted market debt, see the spread here. And then once the market debt started moving higher, in other words, it was shrinking, that's when the market started selling off. Turn the table to 2007, here's your spread again. When the market debt started turning up, that's when the S&P started selling off. So these prior two spreads, and then once the market debt reversed, were 50% declines in the S&P. So you can see right now the market debt's off the charts, or it's at the levels not seen in American history. But the key to me is not only is its level, to me what's more important is it's starting to contract. And it's starting to contract while the market is still lofty. So to me, charts are the answer, but this is not something that you can go change your asset allocation, because price is your friend. You know, let the price be your answer point, not this, folks. But I think just like the tornado chart, you should be aware of these conditions that are taking place. Another one that why I wanted to have this webinar when we are is looking at the smart money, dumb money confidence spread from sentimenttrader.com. And there's always a great question, what's smart money and dumb money? According to them, smart money is the group of people that tend to do the right things at the right times, and the dumb money are the traders that tend to be on the wrong side of the fence. They're the group that's most likely to buy at the highs and sell at the lows. And so the reason that I wanted to just show this today, from Sentiment Trader, is that dumb money right now is very confident that the market's going to go higher. And it's, as you can see, it's back at the highest levels, or touching the highest levels of the past year. It goes back to February of last year when the S&P and the NYSE and a lot of indices started struggling. And then smart money is at the most concerning level of any time in the last couple of years. And so when we look at this from the opposite point of view, where were we last Christmas? Anybody last Christmas? So here was last Christmas at the market low. Look where dumb money was. They had virtually hardly any confidence that the market was going to rally, and smart money was betting big time, had the biggest bet that the market was a good opportunity for people. So you can see in summary of this that dumb money is very confident that the market's going to rally in the short term. They've got the bad track record, and smart money right now is very concerned that the market's near a short-term high. And so this is just a look of dumb money confidence by itself. You can see in the upper right how high it is, and then I highlighted in the pink shaded bars other market tops or market peaks or when performance was subpar over the last 2 years, and then when the market performance was really good. You can see how dumb money, virtually there was Christmas again. Look how little confidence that they had. So this indicator, typically markets struggle when this indicator's high. Markets are great values and opportunities to back the truck up when it's low. Here's the net spread between the two, smart money, dumb money. You can see that this ratio spread is now the lowest in several years. And again, this doesn't mean that the market has to peak whatsoever right now. Price is the whole key, and charts are going to be the answer. But I want you to be empowered and aware of where these sentiment extremes are. It's cropping up most likely. If you're on this webinar, I wouldn't be surprised if you haven't already heard of this. But two things that sentiment traders have been sharing is the Hindenburg omen and the Titanic omen. They've been sending off some signals that these omens have been triggered of late. I thought this was just a quality chart from Sentiment Trader. It shows when clusters of these both omens have taken place and where the market was. So you can see that their little box here I thought was really revealing that on the NASDAQ, the last 4 days have triggered a Hindenburg omen. Here is every instance over the past 20 years when at least 4 or 5 days had triggered this signal. In all of the 28 days that happened, the market showed negative returns over the next 3, 6, and 12 months. So does this mean that the market has to peak right now? No, but another sentiment extreme. Again, charts are your answer. Let the price be your friend, but don't be an ostrich and stick your head in the sand and not be aware of these things. Andrew Thrasher put out a good piece on that the 9, 30, and 3-month volatility compression is at very low levels right now, and other times when it's been at this level, the S&P has struggled to move much higher. Its performance was much subpar. Thank you, Andrew, for sharing that. Here's our little take on a similar piece. This is the VIX going back over the last decade, applied over the NYSE, trying to look at a little bit broader market. You can see that when the NYSE was peaked here, you can see where the VIX was. And so I highlighted these times when the market struggled. And so you can see, to me, over the last 2 years, it's been really key. When the VIX was at very complacent and low levels, those were the times that the NYSE struggled. And so now we're back at virtually the same level that the market's been 4 different times in the last 2 years. And each time the NYSE has given back at least 5% to 18% in value. Another piece to watch, a lot of the news has got the inverted yield spread. And so this would be a look on the opposite, that actually when the yield spread starts turning up, it can create or signal some market weakness ahead. And so this looks like the TNX, which is the 10-year yield over the 2-year yield. And you'll notice when it kind of had this cupping pattern in 2000, when it started turning up, that's when stocks turned down. It wasn't when the yield inverted, is actually when it was very low and started turning higher. And then you'll notice in 2007, the same cupping process. Then when it broke out, that's when stocks broke down. And so you see a potential cupping process again here in the lower right. So keep aware of the TNX 2-year yield spread. If it would happen to turn higher, that could provide some frustrating evidence for the market. Again, we shared this chart earlier. The NYSE is testing last year's highs. And so we're going to have a quality breakout. Is it going to join the Dow? Right now, the odds are is that it will, because of the advanced decline line. The S&P is above those highs, the NASDAQ's above those highs, and the Qs are above those highs. But to look for confirming evidence, you'd like to see one of the broader indices, being the NYSE, breakout at the same time. Saw this today from the Holbert Financial Digest, and to me, a fighter or a follower, this is where I think why the average performance, folks, of the average investors is so poor. This blue line is the S&P, and the red line is the total suggested asset allocation of all of the newsletters that they go and look at. And you'll just notice that there's a propensity to buy at the high and sell at the low. And so again, trend is your friend, knowing these extremes, letting the price be your, the price is the only thing that pays, folks, and the charts are the answer here. So again, this is at another extreme. It's back at the highest, one of the higher levels that we've seen in the last couple of years. So to summarize this last section, indicators are at extremes. We're often where markets often experience subpar short-term performance. We just highlighted the optimism-pessimism spread is at a level we haven't seen in a couple of years. Same with the smart money, dumb money spread. Didn't cover it here, but the CNN fear greed indicator is very lofty. We just saw that the VIX level is very low. The 10-year 2-yield spread could be turning up. Margin debt is shrinking from all-time high levels, and we're seeing some Titanic and Hindenburg omens. And so what do all these things mean? To me, it does mean to look over your shoulder. You see this guy looking backwards pretty seriously. I think it should mean you should know where the exit door is, and you should have a game plan, be like the Boy Scout, and be prepared. So one of the things that when I look at this chart of this boy with all these ice cream cones, this, in a way, it's kind of like a portfolio. This boy has a diversified set of ice cream flavors, but what's the risk of every one of these flavors? And it has a common risk, and it's heat. And so the thing that before Sir John passed away, he was a champion of diversification, but he said, I think the markets are at risk levels that he hadn't seen in essentially 70 years of his life. And what he meant by that was that markets were so highly correlated in today's world. And so what I want you to encourage you to do is find a way in software that I have. These are all indices, folks. This is the Dow in the upper left, the S&P, NASDAQ in the upper right. In the middle is value line geometric, mid caps, small caps. Then we look to Europe. Here's Germany, France, and London. And the bottom line is these are inverted charts. If you're a bear, you can see this has been going against you. But I wouldn't try to go and own these. We can all own inverted indices. But despite all of these indicators at extremes, I would only own these if they happen to break out above these red resistance lines. So in wrapping up here shortly on our work, these are the high probability patterns that we like, with our favorite, because the trend is up, is the ascending triangle pattern. One of the things, this was a message that we sent to our members here 40 days ago. We were commenting on Apple. Is Apple about to rally 50%? It's okay to question a pattern. It's okay to question me. This is just coming from a pattern. But we like the pattern that was taking place. It was that bullish ascending triangle pattern. This is the pattern that we highlighted to members. We've been patient. It had taken a year to form, but it looked like Apple was ready to break out. And then the measured move suggests that if Apple would break out, that it could rally clear up to the 360 level. So then this chart was produced and shared with members. If you're a sector premium member, you get to see trade alerts like this. This is what was sent on October the 9th. And since then, Apple's up 17% in 40 days. And so this is another example of what you receive. We've sold some shares into strength. And also this is where we raised the stops just yesterday to try to protect some of the gains. So this is the type of thing. So the reason I want to bring up this is here are 6 different ascending triangle patterns that we have buy alerts on for upside breakouts that we want to take advantage of that look just like Apple, everyone. And so each of these have measured moves that will go to in a different day, but these are all opportunities. Again, the trends are up, rising lows are taking place, flat tops. If these break out, could have some of the same experiences as Apple. So, one of the questions is, do charts have memories? And so this is a long-term look at the Dow going back 100 years. And to me, the chart happened to have memories from the 60s to 70s. You'll notice that it traded sideways, but once it broke above that, it didn't look back. But, if we look back, 2 of the most important highs in the Dow were the 1920 high and the 2000 high. So what if you would just tie those 2 points together and then extend them out further? What would you get? What would take place from a charting perspective? And you can see we're butting up against that. And so the Dow has essentially spent the last 70 years inside this rising channel. It's up against the top based upon the 29 and 2000 high, while we're seeing some sentiment extremes. So I do believe charts have memories, and I want to make you aware of some of these long-term chart patterns. Here's another look at that same long-term chart pattern, just a little more illustrated, that once the Dow broke above this megaphone pattern, it tested old resistances as support. It broke out, and then once the Dow in 1987, anybody remember that date, happened to hit this as resistance, we had the short-term crash. And so we got the same action here, and it's testing again the top of this channel. So don't forget, folks, that charts do have memories. And speaking of memories, here's one that I really find kind of hard to believe is when this will unfold. I've never seen anything like this, is that this asset has been in a trading range since the late 80s. So we're looking at a 30-year trading range between roughly $2 and 43. So you can see $2 to 43, almost down to $3, back to 43, back to 2, back to mid-range, back to 2, back to 2, and now we're back at 43. So this is something that we're sharing with members right now. I just want to kind of let you guys know, guys and gals, this is a heck of a memory opportunity. This is either going to break out or this is going to break down. I'm not going to share the answer today. This is for members only, but I just want to share that this is a real rarity. And to me, as we see Tom Cruise in the upper left, this is going to be some big movement. This asset has shown big movement over the last 30 years, and this is an opportunity that whether you're a bull or a bear, just going to let the chart be your friend. If it breaks out, you want to be bullish. If it breaks down, if you're open to it, you'd want to short this thing. So our third quiz of the day, wrapping up our segment in our sectors and sentiment extremes, is this. And again, the first one to answer this correctly will get a excuse me, a 90-day subscription to the weekly report of their choice. And here's the question: what type of grill does Chris use most often? Do I use propane, charcoal, pellet, or electric? Got any grilling fans out there? All of these work. I do have 3 of these, but one's definitely my favorite, and we'll discuss that just a little bit later. But the answer is pellet grill. It's a Green Mountain grill, but if any of you are pellet grill fans, I'd love to open up communications and we'd share some special rubs, some of your favorite meats, things that works out really well. I've got a lot of friends, in the cooking community. I've been on some occasions where we've cooked for weddings and been in some competitions. So it's one of my passions, and I always love to talk about the passions that we have. So as we're wrapping up today and how to stay current, we have one more prize to give away, which is the biggest of all, but the biggest of all is the values and the research that we're going to give away in the following slides. So how do you stay current with our ideas, our research products? We've talked about global trends today, the sectors, commodities and metals report. We didn't even get a chance to cover what is the most popular, and it's actually the bundle of the 3. Instead of trying to you can own each of these individually, but ironically that this is our most popular product is our bundle of these 3, and that's what we actually intended, because each of these stand alone, but when put together, we really think we can help you the most. We also have premium research that we didn't even discuss today that we will on a future webinar. And the prices for each of these reports are $67 a month, but if you buy 2, you get 1 free for $134 a month. Our most subscribed to research package, as we just said, is our weekly combo, which is the global trends, sectors, and metals. You get 1 free when you combine all 3. You get position trade alerts, positions tracking, one-on-one support, and occasional premium content and delayed premium webinars. But here's today's special offer for everybody that we're excited about, and it's for our most popular product. And so if you subscribe on an annual basis to our weekly combo package, we're going to give you another quarter of a year free, or another 3 months added on to the subscription. And not only that, and that's a $402 value in and of itself. So in buying the annual, you get another $402 in free research. Our monthly price is $134 for that package. The annual subscription is $1,297, but so a savings of $311 if you go annual over monthly. But we're also going to add the 3 months, which is another $400 value. But we're not going to stop there. So the total investment, though, of the annual subscription is $12.97, and you save $714 on that today. So, but we're going to go a step further than that. If you order right now, you're going to get access to a live webinar that I'm going to host for advanced charting techniques and how you can, we want to teach. We want you to think. We want you to understand. And so you're going to get this as a package in today. It's a $397 value for this webinar. That it's only going to be available for the people that take advantage of today's free research. And then the first 30 that subscribe today, I want to extend myself. I want to do this for the first 30 that subscribe today to the annual combo package. I'm going to extend a one-on-one confidential confirmation between yourself and me, and we'll discuss charts, stocks that you're interested in, how to interpret the different patterns, signals, and sentiment indicators, how to best take advantage of those patterns. We can discuss your portfolio, your goals, your expectations, how to take advantage of those opportunities, improve your positions, whatever that you want to talk about. So this is going to be something that's only going to be available. It's limited to the first 30, but I would love to get to meet more of you. As I used to do financial planning for over a quarter of a century, one of my greatest benefits was getting to know people, and so I want to extend this offer to the first 30 people of this confidential one-on-one private conversation. I want to share and try to empower you, my 40 years of experience in this business. So it's a $500 value for that time of that 1 hour. So as we summarize this, when you purchase an annual subscription to the weekly combo, you get the 12 months, you save $311. You get 3 months free, you save $402. You get the private webinar, you save $397. And you get a $500 value for the first 30 people, that act on this today. So the total package value is $2,907. Your total investment today is just $1,297 for 15 months of research. And so we're passing along a $1,610 savings. And I don't think it's going to take much of anything with these extremes that we have in the marketplace to pay off that research really quickly. So what we're going to do is, after subscribing, we'll add the 3 months to the end of your membership. So everyone that takes advantage of today's offer will get the $1,100 in savings, the free research, plus the first 30 will their total savings will be $1,610. So this offer is going to expire Monday at market close. That's Monday, November the 25th at 4 p.m. Eastern. So just a couple of questions is, how many trades over the next year would it take to pay for this subscription? And what's it worth having the peace of mind knowing what's going on in the marketplace and us working as a team, together? So again, this offer is going to expire next Monday, the 25th of November at market close. Folks, we believe in our research. We believe in you. We believe in how we can help you and empower you. And so we've got a 30-day, money back, guarantee on all of our research. All of our products and stuff. Makes a decision completely risk-free. So here is the link that you can click on to go to this. We have an entire web page. We're also putting this link in the chat room to the right. So if you expand the orange arrow, you can click on that and jump on and take advantage of this. And again, just the first 30 will get that 1 hour of free time to where we can have a lot of fun discussing charts, investments, exercise, Peloton, grill, recipes, whatever you want. It's between you and I know it's going to be a lot of fun. I look forward to meeting those first 30 people. So the last giveaway today, the first one to answer will get a 90-day subscription to the weekly combo of all 3 of the reports. And so again, expand your box to the right so that you can answer this question. And so the question is, why does Chris put so much meat on the grill at one time? So the choices are: he cooks for a large family, he cooks for friends and neighbors, Chris eats too much, he believes in once a month cooking. He's a fan of the once a month process, or all of the above. So go ahead and shoot your answer in, and the first one to answer that correctly, again, will get a 90-day subscription to the weekly combo. So as folks, as we're wrapping things up, I want to just kind of share these images that we shared in the beginning, and as we go to look at 2019 and 2020 at Kimball Charting Solutions, we're going to do something next year where we're going to have a place somewhere around the country. This is going to be a popular place and easy for people to get to. Our intention is to have a multi-day workshop of the first chart is fitness. We're looking at having some of the most well-known trainers and fitness experts in America attend. We're going to have several people talk investing. We're also going to have looking at having StockTwits there and show their new mobile app on how you get free trading. They're doing some really unique things, and a couple of other companies on the investment side, a couple of the charting pros like myself. And also, we're going to have some well-known chefs from around the country come in. So this is looking to be a multiple day thing. We're really excited about it. We're going to share the dates. If you're interested in this type of a thing, shoot me a webinar and just saying, hey, I'm interested in the Fitness, Investing, and Grilling Symposium in 2020. So I look forward to that. So in summary, folks, this is how to get in touch with us. You know, there are, as we said today, there's 3 different reports that we offer. We discussed those today. For the past 40 years, I've learned that charts, through technical analysis, they tell us a story. It gives us opportunities that help us see the next step to take. Our first report, the Global Trends, points out the right direction, and there's nothing more important than being on the right side of the trend, helping us to become a follower rather than a fighter. Our second report we discussed today was metals. It allows us to take a look at the world and what the metals complex is telling us about those assets. And the chart patterns of the past help us to become a better trader, a better buy and holder, or just a better person to stay out of the market when the time is right. And our third report that we discussed is a sectors report that we looked at many different sentiment extremes that we haven't seen very often take place in the next few years, which means when we see extremes like that, inflection point key points are more likely, and really some really quality money-making opportunities probably are knocking on the door that we haven't seen, in a while. So that was one of the reasons we wanted to schedule all of this. And and wrapping up, as we shared earlier, our research is seen from 167 countries around the world. That's very, very humbling. And if I don't get a chance to wish you or to talk to you between now and then, for those of you that celebrate, Thanksgiving, next week is that special date. It's a week of being thankful this time of the year. I'm thankful for many things, and one of those things is for you taking your time out to look at our research and consider the ways that we can help you make more money in your life. Thank you very much, folks. Have a great holiday.